Hello and welcome to everyone tuning in, hopefully from across Europe, maybe across the world, to the second event of our Solactive ESG Fall Series 2020, which is actually a 5-week-long panel event with a new panel every Wednesday. Today, we are talking about climate impact in the investment process, tools and practical applications. And we have 3 experts on this topic here with me. Before I introduce our panelists, I would like to point out to everyone attending that you can use the Q&A section right from the beginning. Please feel free to post your questions there as I discuss the topic with the panelists. So we can gather the questions and we'll get to them when time fits. Our panelists today, we have Frederick Hildner. He's the head of portfolio management at Salm Partner, which is an independent German asset manager, a signatory of the UN PRI, and an institution with, as I learned, a long-standing history, family history, and hands-on experience in sustainability. We will get to that in a minute, I guess. Frederick, as the head of portfolio management, is responsible for Salm Partners' 2 sustainable funds, one of which includes equities, and the other, if I understood that correctly, is convertible debt. Both of those funds have received the German FNG label and the corresponding Austrian sustainability label. Also with me today is Christoph Klein. He's the founder and managing partner of ESG Portfolio Management, which was recently and just recently included in the PRI Leaders Group 2020. It's a renowned group of only 36 of the 3,600 signatories of the PRI. And the reason for his inclusion makes him a good fit for this panel, which is that basically, you know, the work that ESG portfolio management has done for responsible investing was recognized by this inclusion. He was also awarded Multi-Asset Manager of the Year at the Environmental Finance Sustainable Investment Awards. That was also quite recently. And his firm is running 2 sustainable funds, both of which also have received the German FNG label. Finally, we have Dominic Dare, Team Lead Finance for Right Based on Science. He is responsible for the company's financial sector clients. Right Based on Science is a climate change startup founded in 2016 here in Frankfurt am Main, which calculates the contribution of an economic entity to climate change. Right Based on Science is the winner of the 2019 Next Economy Award, which is also something I learned in my preparation, the top award in Germany for founders who help to shape the ongoing change to the next and more sustainable economy. Welcome, everyone. We will start out with Dominic. If all companies operated as emission intensively as Apple, we would observe a degree of global warming of 1.49 degrees Celsius by 2050. That's a number I came across. Maybe you can introduce me and primarily the audience to the model behind that number, namely the XDC model of Right Based on Science, how that works, how you come up with that number.
Okay, perfect. And yeah, as you said, with Apple, the world will be 1.49 degrees warmer if every company is as emissions intensive as them. And what we seek to do with the XDC model is to do that, is to see is a security Paris aligned. And to get to the number that we got for Apple, what we do is the main input of the XDC model is the amount of emissions over 1 million euros of GVA. And GVA is measured by EBITDA plus personnel costs. So what we do is we get a ratio going, the EEI. And then what we do is we multiply that by the world GBA. And when we do that, we get the global emissions for that particular company if it were to be upscaled to that level. And then we apply various growth rates, and then we get the amount of emissions that would occur between now and 2050. And all this goes into a climate model, the FAIR model. And using that FAIR model, we can then calculate how much warmer the Earth would be. The one thing I'd like to state too is the baseline XTC is useful, but we also have to think about the target XTC as well, which gives us a little bit of context. And so with the target XTC, it's the goal that each company within the sector must reach to either be 2-degree aligned or 1.75-degree aligned. And so what we do then is use the carbon budgets given by the IEA and apply this. So basically we start at the 2-digit NACE level, apply the budgets, and then with Apple, we would have a target XTC of 1.83 degrees to a 2-degree world. So this can sound a little bit funny that this company has to be 1.83 degrees to reach a 2-degree world, but each sector has their own budget. So if we look at a sector like electricity generation, that would have a different budget than telecommunications, just by the nature of what they do. Electricity generation is obviously much more carbon intensive. And so what we do is we compare the baseline to the target XTC. Here, the baseline is lower than the target, so we've met the target, so we can say that it's contributing to a 2-degree world. And finally, for the 1.75-degree world, it's the same concept of the target XTC, but because it's a smaller budget, the XTC is small. It's a harder target to hit. And therefore, we have an XTC of 1.74, so we can say that Apple contributes to both a 2-degree and 1.75-degree world.
Understood. Okay, thank you. And in terms of, so this is for an individual company. And now before we get to Christoph and Frederick, who are actually applying this in their funds, how does this scale up from the individual company level to a portfolio level?
Okay, perfect. So what we do is when we receive a portfolio, as we've received from our clients, what we do is then calculate the baseline and the target XTC for each individual security within that portfolio. And what we do then is to calculate the EEI of the portfolio itself. So we'll look at the portfolio, see how much emissions have been emitted per 1 million euros of GBA, calculate that and get a baseline XTC for the entire portfolio. So not just one particular company. And we do the same thing for the target. Each company has its own sector that gets weighted by the market value in the portfolio. And then we calculate the target XTC for the portfolio. We do a comparison just as we would for the security XTC, or just for the XTC of a security. And then if the baseline is lower than the target, we say the portfolio is Paris aligned. And if the baseline is higher than the target, it hasn't met the target, and therefore it would not be Paris aligned.
So basically the same logic applies. Eventually you get two numbers as an output. You have a baseline and a target. You compare these two numbers and you will see on a portfolio level, as you did on a company level, whether the portfolio is 2-degree compliant or 1.75-degree compliant.
Yeah, exactly, and that's it. It's always looking at the same two numbers. It's just that when we look at it at the portfolio level, we just have to take everything into account. You're exactly right.
And the interesting thing, and maybe to just add one more question to this block, that if I understood you correctly, is that you don't just take a simple weighted average of the single portfolio degree Celsius numbers or XDCs, but everything runs through the model that is running in the background at Right based on science, which is a scientific model, if I'm correct. Maybe you can also dwell on that just for a short while.
Yep, and so the main thing about the XTC model is that we don't calculate a score. It's an actual degrees Celsius number, and I think that's one of the things that differentiates us. And in terms of that, when we look at the world, it's not simply just a linear model where we say we double the emissions and therefore we double the temperature or something like that. What we have to do is, just as you said, we have to go one step back. So if when I give a portfolio, we can't just do a weighted average of the baseline XDCs or the target XDCs to get the portfolio baseline XDC, or the XDC for the target XDC for the portfolio. So what we do is we go one step back and we look at the main input, the emissions over GBA, and then we do the weighted average of that and then that one figure goes into the model. It's almost as if it was a security itself, and then we get the number from there.
Okay, thank you. So now that we hopefully all understood what in the XDC model does, what the numbers mean, we can move on a little bit towards the application side, and I would like to start with Christoph. Can you introduce us to what you do on the fund side at ESG portfolio management? What is your approach to investing? And probably towards the end of your answer, you can let us know how and where the XDC model comes into play.
Yes, absolutely. So we started out and our mission is to have really high sustainability scores in every important dimension. So we want to have highest ESG qualities. We see that as a portion of risk. So extended risk management to have really best-in-class approach. Then secondly, the SDG impact is very important so that we measure this, improve that, and have clearly a very positive contribution and impact. And then it's a climate change. It's a very dominating topic, so super important for us as well. So, and then we measure, at least on a monthly basis, the carbon intensity, but this is backward looking. So we needed something which is TCFD compliant. And in the very beginning, we used the Pract tool, but we haven't been very convinced and happy with the results. So that's why we are absolutely grateful and delighted that we have the opportunity and the support of Right Based on Science, which really moved us a lot forward, that we indeed see the quality of our portfolio, that we are able to improve it further. And very important that we can include it in our engagement. So if we talk to our companies we invest in, climate change is one of our top topics we discuss with them, besides ESG factors, KPIs, SDG impact. So this would be one, how they would be forward-looking, kind of manage their climate risks. So Right Based on Science is a key analytical input for us to be truly sustainable.
Okay. And Frederick, on your side, I mentioned in my introduction briefly that Simon partner through the family seems to have a long-standing history, very practical and hands-on history in sustainable economics, if you will. What of that long-standing history are you applying today? How do you run your funds, and how do you use the XDC model?
Yeah, great question. So on the background of the family, Simon is actually owning Germany's oldest vineyard that has been owned by a family for more than 32 generations already. And the same is true for forestry. And as you know, famously, Mr. Karl Kalowitz back in the day said or defined the term of sustainability when talking about forestry, and you shouldn't take out more wood than what is growing in a year's time organically. So most probably that's the root of the term sustainability. We don't know for sure. But after all, forestry and vineyards and agriculture, all that is something where you have to deal with the nature, with the limitations of the nature, and where you are exposed to natural volatility and risk, certainly. So actually, there's a lot of parallels to portfolio management. And so being sustainable in the hands-on businesses of the family also meant to us that we should do the same or apply the same principles in the financial business we're undertaking. And so we joined PRI, one of the early signatories in 2012 it was. And then back in the day, we started applying ESG criteria to convertible bonds, which is a niche asset class. It's 400 billion worldwide, but it has particular advantages for investors looking to, balance and mitigate risk versus return. And so we developed from there, and by today we have one of the strictest ESG approaches that is actually out there in global convertible bonds. We are applying the same for equity exposure. But 4 years ago, more than 4 years ago, we also decided to see climate as a factor and as a trend, as probably a mega trend, as ESG was already back in the day. And we wanted to be, again, early on the curve, early adapters, and understand it in depth. And so we have a more than 4-year real track record in Paris-aligned global equity exposure. We are applying the same to our convertible bonds exposure, although I admit it's a little bit more difficult for convertible bonds because it's a niche. It's a niche consisting mostly of mid-caps, which have some issues in reporting. I think Dominic, knows well about the bits and pieces in this market. They analyzed our portfolios, and I think with the help of Right Based on Science, we've been able to take ESG to a next level, actually. And especially, I want to point out one thing which is important to me, which is the difference of temperature alignment versus carbon footprinting. Under ESG, we've been doing carbon footprinting forever, basically, which is a good thing. The only pitfall is basically that you measure things in absolute terms. So when you want to look good against your benchmark, as an example, you are underweight on utilities, and there you go, you look light on emissions, and probably that's a bit misleading. So therefore, we can only praise the concept of temperature alignment, and with the help of Right Based on Science over the last years, we really found that sector-specific targets and company-specific targets within the sector are much more interesting and tell you much more about how temperature aligned or aligned with Paris Accord your portfolios actually are, and therefore that's a big difference. Also, one more thing before I stop the monologue here. You mentioned it already. Scope 1 and 2 is standard in carbon footprinting, which is nice, but there are some companies that have, a lot of the critical stuff going on in the supply chain, which isn't measured in today's standard carbon footprinting offerings by some of the ESG research providers that we all know. So therefore, the model of the XTC model of Right Based on Science does include Scope 3 emissions, so you have a view on the company's whole activity, which is also very interesting and helps a lot.
Yeah. That's actually quite an interesting point when you speak about Scope 3 emissions, because we also have this discussion sometimes, with our clients when we talk about ESG in the indexing space. Maybe, I don't know, Christoph, Dominic, if you have a view on this, what is your experience? I think in general, my feeling is that you kind of have two parties at the discussion table. One is the party saying, okay, the data is not good enough when it comes to Scope 3 emissions. We should leave it out. It just creates some, spurious noise. While other people say, okay, even if the data is not as good, it just represents maybe the largest amount of emissions. So we should include it, even if the data is potentially not as good. What's your view on that?
Sure, I can start on my side. And yeah, one of the things I do agree is that Scope 3, it is difficult to measure. It's not easy, and it's inexact. And there are issues, and going forward, I'm sure we'll reach a better solution, but we're not quite there yet. And The one thing, at least what we do with Right Basin Science, is when we give an analysis like I've done for Mr. Klein and Hildner, is that we do split out everything out by scopes 1, 2, and 3. So you can see the impact of each individual scope on the portfolio as well. And it is difficult because scope 3 makes up such a huge portion of the overall emissions. It just seems like such a disservice to ignore it. We really want to try to, it has just the potential for large savings. It is nice to lower scopes 1 and 2. I'd like to see that, but for scope 3 makes up such a large portion of the overall emissions, it's just really a disservice just to ignore it or throw your hands up in the air and say that there's nothing we can do. And one of the projects we're working on our side is to look at the whole value chain of a company and then try and calculate a scope 3 from that. So if we look at a company and we see their value chain and we can calculate the XTC for that, just as we do with a portfolio, it's no difference. What we can think of, one is the value chain and one is as a portfolio, and they're just a collection of companies. And if we do something like that, that can hopefully get us a better scope 3 figure and can provide more accurate results.
So I would fully agree with that. It's so important that we have absolutely no time to waste. It's now, I think, not acceptable anymore that we can say the data is insufficient or the quality not appropriate, that we wait for better data. So we need to act because climate change is a maybe most pressuring risk we see on different dimensions. So that is why, we engage ourselves to ask companies to provide more data, better data, but we also applaud organizations like CDP or Gentem, who are a standard setter in the space. So they have questionnaires, they ask, and they make it comparable, and they kind of fill the gaps, which is very good because we as asset managers alone couldn't do it. And if we won't have standards, it would be a mess also for the companies themselves. So having a point of entry is very helpful. And we applaud Right Based on Science, as Dom just mentioned, breaking it up in different scopes, then we can really compare and analyze and see, where do we need to have a second question, second thought, talk directly to the company. So it's a fantastic starting point.
Okay. So maybe to get back from our little detour and focusing again on the funds that you mentioned, and maybe for our audience, can you, Christoph and Frederick, break down or maybe just give a brief description of the separate funds that you run? We've heard a little bit on different asset classes. What are the particular steps that you take? I think from what I have heard, I understood that the XTC model is by far not the only input into your process of creating the final portfolio. What's going in? What are the different steps for someone who's listening and wants to understand, how you construct your portfolios?
Okay, if I may start. So for us, it's a very complex puzzle because we want to optimize every important dimension, but we follow a process. First of all, we need to look at our positive list. Are we allowed to invest in the company? So we have a very long list of exclusion criteria. It's not only FNG designation, but also both churches and many more. So it's a long list. And after that, we see, is it really best in class, ESG-wise? Because our goal is to have the kind of top 1 percentile ESG quality for our fund. So that's why at the moment, our worst ESG rating is single A, and we just have 1 or 2% because it drags our score lower. Then the next step is looking at the SDG impact. Here, a normal ESG benchmark has something like 5 or 6% measured by MSCI ESG, which is tough. And our balanced fund at the moment is running at 48%, so it's factor 9 times impact. The corporate bond fund is at 35%, so also higher compared to benchmark. And then comes the climate discussion. The carbon intensity is like a third of the ESG benchmark. And we are right based on science is very important for us. As I said, TCFD compliant is crucial now to be forward-looking, to have assumptions going forward. And we are very happy, and thanks to the support of right based on science, we are 1.75 aligned. And we want to optimize from here. So we have the universe available. As I said, we can engage with companies and hopefully push them that they become better, but also we can select the climate leaders in the industry. So hopefully we will approach 1.5 and become better. So it's a constant process and we need to consider all important dimensions.
Thank you.
Great, interesting. So I pick it up there. For us, it's as well complex. It's a process of many steps, but we also start obviously with a universe for the global equity exposure, which is Paris aligned under the 2 degrees scenario, or the lowest available at the moment by right based on science is the 1.75 degrees scenario. We take it from there on the positive list, and then we apply our ESG criteria, which consists obviously of exclusion criteria. Every box is ticked that you can tick. Again, it's also having some factors that stems from church investors in German-speaking countries. Then we undertake best-in-class optimization for the remaining universe, which means we only invest in the better half of the remaining universe after ESG exclusion is filtered out. Then we apply our in-house analysis and basically, take a step back and think about whether something actually makes sense, because recently there have been, some, things provided by the ESG research providers where I say, a landlord that's renting out retail space to retailers and is then excluded because it's supposed to make revenue with fur, which is not the case. It's just because one of the retailers that they rent the retail space to has a certain percentage of its revenues in fur. Does it make sense to exclude this company when the rest of the whole company is very good in terms of climate and ESG? Probably not. So it's not a only data-driven approach. We are always testing this by having our minds on, basically. That's a very important factor to give it a sanity check and just not trust what's coming from third parties. So that's one of the, that's basically how the process goes. What we achieved in global equities over the last 4 years is basically the same performance as the MSCI World Index in Eurohedge terms did. But we achieved that with a portfolio which is 1.75 degrees compatible and is, according to right based on science, 0.4 degrees lower than that. So even better than the Apple example, probably, on average, which we think is quite stunning. Not because we managed to achieve the performance, I'm sure we could have done it, but it's now proven that you actually can have a very good climate portfolio and it economically works. It's basically the same as we all, talked about in recent years on the ESG front. And I want to add one thing here. It was just out last week, a study by a sell-side broker, and they looked at the numbers for the last 8 years on the factor performance that ESG brought on global equities. Most of you will probably know that, but in a nutshell, it said that over the last 8 years, ESG leaders outperformed the equal weighted index by about 18% to the upside, while ESG laggards underperformed the equal weighted index by 15%. So in sum, that's over 30% in just 8 years. And whether you like ESG, climate, or you don't like it, it doesn't matter. It's a performance factor. Accept that. Everyone out there should accept it rather early, because it can weigh on performance, or it can be a factor for your outperformance. And that's what the truth is for ESG. And we are very happy with the widespread adoption of ESG. But what we also observed in the numbers is that most of the outperformance in ESG factors came from Europe and Asia ex-Japan, while in the US, ESG leaders actually slightly underperformed. So what does it mean? I would suggest that probably half of the effect that ESG would have on financial flows, on outperformance, is true. But the other half is most probably yet to come, especially in the US market. What does it mean for climate and temperature alignment? It means that when we are at the beginning of a mega trend in temperature alignment, it will be a massive performance factor going forward, and it will help you to reduce and avoid risk, stranded assets, stuff like that. And it will help you to spur your performance to the upside. And why do we think it's going to be a mega trend? Because one major difference versus ESG, which was on a curve that went from nice to have to feel good to, okay, everybody does it. And finally, if you don't do it, you're probably not in the marketplace today. But for climate, there is one pressure, which is the regulation. And that's coming, and it's coming fast. And it's good. It's good like that. So to us, the adoption curve or the spreading of climate in the financial industry is going to be on a much faster, steeper trajectory than ESG ever was. And it's a whole different, separate discipline. So again, whether you like it or not, it will be a performance factor. Just accept that as you accept all the other factors.
That's interesting, and we'll probably keep the thought on regulation for just a minute. I saw Christoph was nodding a lot with his head. Maybe you want to add something to this, especially I wanted to ask you anyways, in terms of the performance, whether you made similar observations in terms of, incorporating it as a risk factor instead of just using it as a purely ideological argument when you try to speak to clients. Yeah,
I fully agree with Frederick. So the trends are clearly there. So for some industries, you have the stranded assets problem. So it might be less than worthless. You have costs without any kind of revenues or free cash flow. So it can be really dangerous. And you have two perspectives which are important. If you analyze a company, you have inside out. So what we do with Right based on science, what is kind of the company doing versus the climate? But then you also have outside in. So what is kind of this increasing deserts, less food or water supply, increasing water levels? What happens when you have assets, companies, whatever, on a coastline, and the storms are increasing? So these are questions you need to ask if you buy a 10-year bond, because things are happening so quickly that you need to have a scenario analysis and a base case, a worst case, kind of in your head if you do investment decisions today. Because the big kind of trends are now to analyze transition. Can companies adapt and mitigate these risks or not? And how do you react as an investor? And hopefully, when we look ahead and we are really constructive and kind of knowledgeable about these things, with our constructive critique, we hopefully can give some signals and kind of talk to the management to improve or to avoid risks and reduce risks. And that is kind of a big task and a big responsibility we have to bear as well. And we are very happy to shape that and to work on that. And also the PRI is a fantastic platform to collaborate. because it's difficult to do everything on your own, but you can form kind of investment groups, collaborative engagements, and then you have much more leverage, power, more knowledge sharing, more networking. So this is absolutely helpful going forward. And some companies who still not report haven't understood the importance of it. I think in 3, 4, 5 years they will have significant problems. And given the regulation we have talked about, and one of the big things is the EU taxonomy, which is clearly asking about climate risk. And again, is it already green? How many percentage points of turnover is green? But secondly, the transition. So exactly the forward-looking items we are talking about, kind of operation expenditure, capital expenditure to improve and reduce climate risk, we need to assess that. And it's hard work. We have been invited to write a case study, how we apply the taxonomy ourselves, because the data is not yet provided by the companies, and next year we need to deliver. So I already know what we're doing during Christmas break. It will be calculate the EU taxonomy aligned for our portfolio positions, because it's a lot of work. But this is kind of the necessary step to get an eco-label next year. And I would recommend to all investors look into it and start early. Otherwise, it will be tough. And if you decide to wait for the companies to report on their alignment, you might miss a boat.
Yeah.
Okay, thank you both very much. Very interesting. Dominik, anything to add to that overall block? I think we discussed performance. We discussed how the XDC model is used. Maybe to sum that up a little bit. And what's interesting to me is that it's not only used as as an input or as a means for security selection, but that it also spans to the area of engagement with companies. And I guess, if you manage to be very successful, all companies will speak the XDC language. And so it's much easier, obviously, to communicate with those companies that apply the XDC model, like we have seen last week, by the way, as we interviewed Continental in our panel. So yeah, maybe anything you'd want to add to this block from the perspective of the data provider?
Yeah, well, just not speak about the engagement. I definitely agree. And, I hope this is something, it's something, a number, something physical that you can go up to a company and say, why are we emitting so much and contributing so little? It's something that we can reach out to companies and, not necessarily us, but say portfolio managers or asset managers and say, why does it have to be like this? Or, we also have a sector XDC where you can compare a company to the other competitors in the sector. And you can say, well, why are you so far off from everyone else? What are you doing wrong? How can this be fixed? And in that, it can really help engage. And even another thing, we have a scenario explorer. So sometimes companies will have plans to reduce carbon. And then, that can also be used to see, does this plan make sense, or how much of an impact does this have? If a company says we're going to reduce carbon by 5 or 10%, what does that mean in terms of a temperature alignment? And I think that's very important. And yeah, just to discuss the return, that's one thing we're thinking on our side, and we're going to have a white paper coming out soon that talks. It kind of shows a correlation between some of the returns that we've seen in Europe between 2013 and 2020 and link that with the XDC gap. And it seems companies with a better XDC gap, companies that are meeting their target, tend to do better during the time period that we analyze the securities. So, I think this is something that can lead to return as well.
And the XDC gap, maybe just to clarify that for our audience, is the difference between those two numbers that we ran or that we presented for Apple in the beginning?
That's right. So the XTC gap would be the XTC, the baseline XTC minus the target XTC. And so if the gap is negative, that means you've kind of already reached your target. So if a company has to reach 1.9 degrees Celsius, if they're at 1.49, then they've obviously have done well and they have reached their target. So those would be companies that you would want to invest in.
Yeah. And one thing I wrote down during the discussion, which I think might be interesting as we hopefully have attendees joining from, managing different assets. And we've briefly, Frederick and Christoph touched on this, that, this can be applied, although with difficulties for different asset classes, the entire process, but maybe we can start by focusing on the XTC model. Dominic, so if you, does it make a difference to write based on science, whether you are analyzing an equity security, whether you are analyzing a fixed income security? And if a client is facing a situation where they are analyzing unlisted companies, what do you require if you still want to help those clients?
Yeah, so luckily on our side, for an equity or fixed income, it's all the same input that's needed, which is the emissions over the GBA. So if we have a BMW bond or BMW equity, it's going to have the exact same XTC. So from that, we're fine. And to discuss convertible bonds, which came up, it's the same there, although sometimes the underlying can be a different equity. So maybe it's a little bit different there. And in terms of unlisted securities, it is possible with our emissions provider, Urgentum, we can get the emissions data and they can model it, as like they know the sector and the amount of sales. And if we can just get the EBITDA and personnel costs from the company itself or through a service provider, then it's, we can calculate it just as we could a listed company.
Okay. Maybe back to you, Frederick, Christoph, any observations that you have made on using this for different asset classes, be it in terms of performance, be it in terms of constructions, anything that you can throw out there for someone who's listening and who's looking at that very same asset class probably?
So we are doing especially equity corporate bonds, and we are very happy with the universe. So it can grow in the future, but our coverage is very, very good already. So we have good insights thanks to a write based on science. We feel pretty okay. We need to start, improve, and engage with companies. And we are very strong believers that this is the foundation for future performance. If we have kind of companies which are already understanding the topic and are sector leaders, invest in technologies and improve even further, I think they will have an advantage. And this should result in better performance going forward. And this is, in our opinion, true for equity and corporate bonds.
Yes, great, thanks so much. I would add one thing here. As for the difference between global equities and convertible bonds, we see obviously that a narrower universe leads to less choice, which is also the case for ESG, or has been the case. But for climate, it also means that in the niche of convertible bonds, we can not yet, without impacting the economics of the portfolio too much, achieve the same climate metrics that we can achieve for global equities. In other words, for global equities, we hit our goal. We are compliant, like I said, with the strictest scenario, and we are by far below that. And economically, obviously, it did work out quite well. But there's, coverage. I'm with you, Christoph. Coverage is more than 90, usually more than 95% for all of our portfolios that we talk and analyze together with Write Based on Science. So that's very good. They have done tremendous effort on that front, and this is a great achievement. But for convertible bonds, I give you the figures. We are just above 2 degrees scenario. We are working on improving it, but ESG and climate is very important. But after all, the economies of the portfolio are at least equally important. So it's about making returns in the long run for our clients, and then aligning it with temperature and ESG demands. And so in converts, like I said, we cannot hit the target yet. But I'm hopeful that going forward, more and more companies will simply put more effort on the topic. And then again, we are talking about regulation. So sooner or later, once it impacts the stock price, once it impacts the cost of capital, it's going to get massive. I give you just 2 examples maybe on this. EDF, Energie de France, came out with a green convertible bond at very favorable terms for them. While usually many sustainable investors would never have bought anything of this issuer. So there was a meaningful impact on the cost of capital in this particular transaction for EDF. That's been one of the first green convertible bonds, by the way. I'm sure we're going to see more of this in the future. Also, 2 little bits and pieces, signs on that climate is just about to take off in terms of adoption. We see long-short hedge funds in the US already front-running the things to come. So they are long climate leaders and short climate losers. Yeah. So that's one thing. And there's big money behind that in the US. Some guys are earlier than others, but it's happening. One more thing, we've been talking to government pension funds in the German-speaking area of Europe, if I can say it like that. Christoph is smiling, knows what I'm talking about. They just decided to be Paris aligned by the year 2030. Starting point, 0, no clue what to do. So that it's going to affect billions and billions and billions of euros and dollars around the globe. The effects are probably going to get massive. But one thing we haven't talked about yet is the client. What is the client's? What's the client's demands actually? And on that front, I also just made the experience that the investors behind our assets that talk to their clients just told me that the next generation of their clients is already asking about climate in the investment process. They are demanding that because, like I said, ESG is something that many of us can offer. Some do it on intrinsic belief, some do it because it's just a megatrend, some do it because it's an economic factor. The main takeaway is they do it, and it's good. And if it's going to be the same for climate, I think you got to do it for the performance. You got to do it because it's going to be a megatrend. But most importantly, you got to make your clients happy, and your clients are the next generation in 10 or 20 years' time, or even faster, and they will demand this. If you can't deliver, you got a problem.
Christoph, you're again very easy to moderate because basically a lot of interaction going on. So Christoph, please, if you want to add something.
Yeah, I fully agree. So, but I sense like Austria, France, it's a bit, Scandinavia certainly, it's a bit advanced. So what we advise, and we are very service orientated, we say, if you become a client of us, invest in our funds, we help you. we spend time to explain how can you assess risk of your other assets as well. And with that, we spend time, it's hopefully a good connection and maybe some good conversation and maybe knowledge transfer and conversation. We are a bit wondering that we do not get more inflows at the moment because honestly, we are winning awards like on almost a monthly basis now. So we are seen as sustainability leaders, but it's not, the action is really not there because everybody says and talks about climate change, sustainability, but we don't see the flows so much yet. And I wonder why. Because it's urgent, it's a pressure, and as I said, we are very happy to support you if you become a client.
Yeah. Do you think there's like a point of no return where basically you will see a massive shift in assets? Or I guess at least you would be hoping for that. But taking together what you say and what Frederick has just said, it seems like we are steering towards that point, right?
Yeah. So we need to be a bit patient, maybe. But at the moment, currently, I'm wondering a bit.
Okay. As we are approaching the final minutes already, I would encourage again all the participants to post their questions as quickly as possible, so we still have some time left to answer them. There is one question already in the Q&As, and it's for Dominic and Right Based on Science, saying, we know that in traditional finance, the variance of a portfolio of various stocks will tend to be lower than the sum of the individual stocks variance, right? So if you sum up the variance of the stocks, it's larger than the variance of the portfolios. And the attendee is asking whether a similar concept applies to the XDC model. Would a portfolio of stocks have a lower XDC than the sum of the individual XDCs, and can you optimize for that?
So in this case, there wouldn't be, unfortunately. So when we look at a bunch of securities, there's obviously some idiosyncratic risk, and the winners should offset some of the losers and so on. But with carbon emissions, it's something that every company emits. So you can't mathematically be any lower than the lowest company if you run an average or anything like that, no matter kind of how it's weighed. You'd have, so it's unfortunately there's no way you can minimize your exposure to carbon by picking companies with lower baseline or XDC gaps, but there's no way to get pick 5 securities and somehow combining them makes it greener than what they already are. So unfortunately not.
Okay, can you tilt, like if you have a portfolio and you apply different weights, obviously from what I understood in the beginning, you cannot just experiment easily because you would have to put the different combinations through the climate model to see what the final temperature of the portfolio is, just because climate science is not a linear science, so you cannot just add and subtract and take averages. But would it be possible in theory to kind of apply different weightings and influence the portfolio XDC by that?
Yeah, so there's some software we're developing right now that'll do that. So, we have received, say, portfolios from, ESG Portfolio Management and SamSam, and, we give them the information maybe 2 weeks later, something like that. But people want something more immediate, and I can understand that. And so we're developing software where you just upload a CSV file, and then you can get everything immediately. So then, you upload your current portfolio. Then if you want to play around with the weights, then you can upload it a second time, and then you can compare the results between the 2 portfolio XDC gaps and see if you're Paris aligned or if you're more or less aligned. So that's something we're working on. That should be the January 2021, and that's something I'm very excited about.
Can only agree. We took a preview, and it's going to be a game changer for the portfolio management or financial industry. Applying concepts is really a lot of fun by using this tool.
And it's something, the notion that climate science is not a linear science, right, is probably, so when I learned about this with a financial background, where we like to take weighted averages a lot. It's something very interesting to learn, but it's also, to me, it seems good in the sense that you understand that what you're doing in the area, when you integrate climate risks into your portfolio, it's not easy. It's not supposed to be easy. You're supposed to scratch your head a little bit from here and there. What Christoph and Frederick have probably been doing for the better part of the last couple of years. But that's certainly an interesting observation, right? This non-linearity.
Yeah, certainly. I mean, that's in life, like there's kind of, I guess, no simple, it's never easy, there's no easy answers, but hopefully, once you work with us, you can't say that it is easy, but sometimes, it just takes a little bit of understanding to get there. Once you see the results, I think it's pretty easy from there, but yeah, I understand your point.
Okay, I think it seems like we are approaching 4 o'clock quite rapidly, and I don't see any other questions in the Q&A section. Is there anything that any one of you would like to add as a closing statement, probably?
I'm sure if I could say something, I guess. I would like to thank Mr. Klein, Mr. Hildner for being clients of us, and having analyzed the portfolios and seeing that they are Paris aligned. It kind of makes it a little bit more real on our side. We do a lot of analyses and we do some things like that, but when we actually get a portfolio, we look at your universe, you bring us the new results, and we can say it's Paris aligned. It's something that makes me very happy, and it makes me feel like hopefully we're on the cusp of something greater in the future. And so I want to say thank you to you too.
Thank you.
A great pleasure working with you guys, team at Right Based on Science, Dominic, especially you. But also let me say that for everyone listening to the call, we can all only encourage you to, make a contact, ping me, Christoph, Dominic, or anyone here, and let's discuss the topic, get together on the curve of improving our portfolios in terms of temperature alignment. We are here to help, and that's why we do the panel today. So thanks a lot for your interest.
Thank you very much. Very good. Thanks to Solactive as well. Thank you.
Thank you. So perfect closing word, I guess. I will not stop, but will leave a little teaser for our next panel. As I said in the beginning, the Solactive ESG Fall Series continues next week with something that we have not quite touched on today. We talked about engagement. Next week, we're going to talk about voting. The topic will be sustainable stewardship at the crossroads, the role of proxy voting. We will have Minerva CEO Sarah Wilson on board, and Kimberly Fisher from Barnett Waddingham, who will discuss this topic. I hope to see many of you next week again. Follow our social media channels to stay posted on the registration process and anything coming up. And thank you all very much from the Solactive side, and stay healthy. Thank you.
Great. Thank you very much.
Thank you.
Thank you. Bye.
Bye.